Hello and welcome to a brand new edition of Smart Money. Since it's the beginning of the new financial year, we've decided to address a lot of the queries that we get from young earners, young investors on how to make smart financial decisions. And we've put together all of those queries. And today we're going to talk about that. Our expert today is Mrin Agarwal, who's a financial educator. She's a director at Finsafe India. And she deals with a lot of retail investors on a daily basis. Mrin, thanks a lot for joining in. And you know, we've got so many queries. We've decided to address all of that with you. So without wasting any time, let's first start with the tax regime, right? In the budget of 2023, the new tax regime has been made a default one. Now, all of us are struggling to understand whether I choose the new one, I choose the old one. How does one evaluate which one is better?
So good afternoon, Sonia, and thank you for having me on the Smart Money Show. Yes, this is something that everybody is grappling with today, whether to go for the new regime or the old regime. So first things first, the new regime is actually very simple because it only allows for a couple of deductions. The first one being the standard deduction and the second one being the NPS-CC D2 contribution, which means this is the employer contribution to NPS, right? It doesn't allow for any other deduction like, for example, ATC, ATD, ATE or the Section 24 benefit towards home loans that you have or the allowances. None of these are allowed as deduction in the new tax regime, right? So how do you figure out? Well, there is a calculator on the income tax website that you can actually use to figure out where you are paying a lower amount of tax. And as such, what I have seen is that in the cases where the deductions are above 3 lakhs and the incomes are also higher, I think the old regime is working out better. But essentially, you can find this out for yourself by using the calculator that's freely available on the income tax website.
So, just to make it a bit more simpler for our viewers, if you're someone who perhaps is paying house rent, has taken a home loan and you're paying EMI, so it's better to stick with the old tax regime, right? Or is it a possibility that I can perhaps switch between regimes as well?
Well, you can. And, while the new tax regime has been taken as the default regime in case of most employers, you have the ability to file your returns under the old tax regime. So as a salaried individual, you can switch between the regimes whenever you want to. So even if you declare new tax regime to your employer, you can still go ahead and file it in the old tax regime if you find that during the year you've made all of these contributions and the old regime is working out better. But remember, this is only for the salaried. For people who are in business income, they have the ability to switch only once, and then they have to stay with that. Either way, what I would say is that do your research, figure out which regime you want to be in, because honestly, filing every year in a different regime is not going to be exactly very easy, and it's going to be quite cumbersome for you to, keep a track of everything, So I would say that, do your research, figure out the one that you want to go with, and then just stick with that.
But so someone who's watching us perhaps between the age of 20 and 30 has either taken a home loan, is paying an EMI, or someone who's perhaps paying house rent. Is it better to stick with the old regime because you get deductions there?
Yes, if your deductions are above 3.5 lakhs, then probably the old regime might work out better.
Okay, and what should one keep in mind as far as the new regime is concerned?
Well, a couple of things. You cannot file belated ITR in the new regime. So if you miss the deadline for filing ITR, which is July 31st, then you necessarily will have to file it under the old regime. The second thing is, of course, while the new regime gives you more cash at hand, you still do need to make all of those investments for your financial goals. And so, of course, you need to have a very good investment strategy, or you need to ensure that you're making those investments and really not using up that cash for lifestyle expenses.
Okay. In fact, since you talked about our financial strategy and investment strategy, many young earners that I interact with are very intimidated by this whole process of investment. They're not sure how to start investing, whether to buy stocks, whether to buy mutual funds, and within the funds, what to buy. So tell us, for all the people who've just started working, who've just accumulated some money, what's the best way to start investing?
Well, this is the most common question that I get. What's the best investment? And honestly, before you go towards that best investment, it's always important to be prepared for uncertainties. So if you don't have an emergency cash, then I think first you need to look at building that. That is typically 3 to 6 months of your expenses kept in fixed deposits. And of course, you need health covers because you could have a medical emergency anytime. And the best way to get it for the salaried is, of course, from your employer, because the employer cover comes at cheaper costs with lower waiting periods and lower exclusions as well. So, these are the first two things you need to do to prepare yourself against uncertainties. And then when you want to start investing, and I know that if you're a young earner today, you've just worked for a couple of years, and here I am telling you to save for retirement. But the only reason I'm telling you to do that first is because when you start early, it's easier for you to do it because the amount that you need to invest is going to be much lower. Most organizations offer a scheme called the National Pension Scheme. And this is a retirement scheme where the money is locked in till the age of 60. And at the age of 60, 60% comes tax-free and 40% goes into an annuity. Now, the good thing about NPS is firstly, it's deducted from your salary, right? If you sign up with your organization, that is. Secondly, it's extremely low cost. And you have the ability to choose the investment options, and you have equity options available as well. Now, because of the lock-in, and I know the lock-in sounds like terribly long, like next 30 years, but you know what? Honestly, the lock-in is what really helps in making those returns because the money is there, it's invested in equities and it's compounding and you don't have the ability to pull it out. So that's what actually really helps in building a very, very good corpus. It's tax efficient too. As I said, 80CCD2 deduction is available under the new tax regime as well and the old tax regime. So I think, to start off with, look at security and look at long-term security as well. And look at building that first before you really look at starting to invest.
Okay, very helpful, very, very helpful. In fact, for all of you young earners between the age of 20 and 30, this is how you start, right? First, you keep 3 to 6 months of, your salary aside so that you can build an emergency fund. So that's what you need to do first. After that, you need to look at insurance. A term insurance is the most helpful thing for you if you are a breadwinner of the family, if you have dependables. And the third thing you look at is the National Pension Scheme. Now, what we've decided to do here, and Mrin has very helpfully put together a table for us on how the National Pension Scheme compares to equity mutual funds and what is a 5-year and a 7-year return that you can get. So if you look at it, the tier 1 plans in equity, there's about a 13% return in 7 years. In government bonds, there's 8.5%, and in corporate debt, about 8%. So tell us, Mrin, how does the NPS compare to equity mutual funds? We'll, of course, get to mutual funds and the contribution you need to make later. But on NPS versus mutual funds, anything you want to mention?
Yeah, so actually, I just want to say that on the equity returns that I have shown, this is an average of all the equity pension funds, like all the pension funds, the active equity options. I've just taken an average of that and, given out these particular figures. So, honestly, I think, returns apart, I think when we are evaluating the NPS versus an equity fund, because clearly today, if you have a 25, 30-year horizon, both are options for you to invest in. Now, the difference really is that on the equity side, of course, there's more flexibility because there's no lock-in. And I think it's pretty low cost as well. But of course, NPS is much lower cost. So I think, the big difference is, do you want to manage this investment yourself and have more flexibility and liquidity? Or, if you find it very difficult to figure out which equity fund do I want to get into, you have this product that's available. And of course, the other point that one has to think about also is that it's going to give you a fixed return after retirement as well, right? So I think it's really a difference of where you are more comfortable. Are you more comfortable figuring out things yourself and having more flexibility? Or if you feel that it's okay, let me just log this in because it'll get taken care of and I'll get a pension and it's tax efficient anyway. So again, it really boils down to your comfort factor.
Okay, and that's also a really helpful table, right? We just get that up on the screen. The difference between investing in a national pension scheme and investing in mutual funds, both large and mid-cap. Here you have it, very helpful. For 10 years, if you invest in the national pension scheme, on an average, you can get about a 12-13% return. In equity mutual funds, of course, if you higher risk is higher return. So in the mid-cap space, there's higher risk, and you can make about 17%. These are just on an average. It may not hold true in the next 10 years. But large cap returns are about 12%. In any case, by investing in these products, you are beating inflation. So that's what you've got to start doing immediately. Let's talk a little bit about within the equity mutual fund space, right, Mrin? There are so many different categories of funds. Which ones are you recommending and why?
So actually, the returns that I have actually mentioned over there, these are past returns. And as you mentioned that, these may not play out in the future. So certainly, when you are looking at investing, don't go by these returns. I mean, this was just to give you an idea of what's happened in the past. And as we all know, the disclaimer that past returns are not indicative of the future returns. So do keep that in mind. Now, within the equity space, there are, of course, so many different categories of funds that are available. And it gets a little difficult for people to figure out as to where to put, where to invest. And especially what happens is that most people go by the near-term performance of funds and choose funds based on that. Ideally, you need to always be well diversified within the equity space in large, mid, and small cap stocks. And a good way to do this would be through a combination of a couple of categories, like, for example, index funds. So you can have a Nifty 50 index fund, which will give you exposure to large cap stocks. You can have a mid cap fund. And I think, while the actively managed mid cap funds, there are a couple of funds which are consistent outperformers. And I would actually highly recommend an actively managed mid cap fund. At the same time, I will also manage an actively managed flexi cap fund as well, because in the flexi cap, you're getting exposure to large, mid, small cap. And of course, there are a few funds which also give you international stock exposure within the flexi cap funds. So I would say a combination of the index fund, the actively managed flexi cap fund, and the actively managed mid cap is all that you actually need in the portfolio. Now, there are many other categories available, for example, sector funds, thematic funds. There are many other categories that are available. I don't recommend these funds because they tend to be too concentrated, and these themes may or may not play out. Plus, the high conviction bets of all of these would anyway be present in the flexi cap fund. So you don't need to take concentrated bets. So I would say an index, a flexi cap, and a mid cap. This is all that you need to actually really start off your investment journey.
Okay, these are some pearls of wisdom coming in from Mrin. Thanks a lot. We'll slip into a short break, but I do want to ask you about, some of these products which are fancied lately, whether it is PMSs or even in the F&O space, lots of products. I'll come back in just a bit to answer all of your queries. Stay tuned. Welcome back, folks. You're watching Smart Money on CNBC-TV18. Very interesting episode. We've put together all the queries that we've got from young earners and investors, and we're trying to address them one by one. Mrin Agarwal, who's a financial educator, is sitting by with us. Mrin, before the break, you were telling us about the best way to invest, right? But I want to talk about some of these new age investments that kind of have caught the fancy of young investors, and I want to bust some myths. Stock baskets is one of them. So, your small cases of the world. F&O space, a lot of young investors are looking to make a quick buck through the F&O route. What is your advice on products like these?
So firstly, on stock baskets, I think it's a brilliant product. But I would just say that, you have to keep in mind what are the costs associated, because what happens in stock baskets is that you'll have to look at rebalancing on a regular basis. And every time that you rebalance, there's going to be a cost associated, and there's going to be taxation associated as well, which is only going to increase the cost. So to that extent, you'll have to keep in mind what the costs are. Of course, it's very concentrated and, concentrated in a particular strategy. So you also need to be clear that, that's what you're really looking at. I would also say that, right now we don't have long-term data on actual performance. And, so I would actually, just keep in mind the fact that today, when you're investing in mutual funds, you have a very long-term history that's available, which is not available in this case. And even though there is some backtested data available, but the actual performance data is not for a very long period, So I would keep these factors in mind before I invest in stock baskets. And of course, F&O, I think, is a complete no. I think recently the regulator also came out with a paper that actually showed that 90% of individual traders actually make losses. So I don't think, these are products for individuals. I mean, even I don't invest in products like F&O because I think it's just too complex, requires a lot of time and effort and monitoring as well. And I think there are simpler, easier, low-cost products that are available that allow you to spend your time in many other things than sitting in front of the screen.
Oh, absolutely. And you get a good night's sleep, right? If you invest in conservative and low-cost products. I mean, that's what's important at the end of the day. So stay away from some of these products, maybe in the F&O space. Stay away from trading if you're a young earner. As well as, don't invest your money in a lot of these fancy products, whether it's small cases, stock baskets, unless you know a lot about this space. What about international stocks, Mrin? Many investors have direct investments in these stocks through their brokerage accounts. And given that international funds are now fully taxable, is this a good option or is it an avoid?
Yeah, I've been getting a lot of questions on this after the change in taxation. And what I would say is that while it's really easy to go ahead and buy stocks directly, most investors are not aware of the tax compliance that there is on international stocks. So one, you have to necessarily file ITR2 if you own a foreign stock. And honestly, there are, I think, 4 to 5 extra sections in the ITR2 that you need to file because you're having a foreign stock holding. And I think, most investors are not aware. And again, filing those particular sections are not really very easy. So you would need the help of a chartered accountant if you have bought international stocks to do the correct filing of the returns. And I just feel that, for a small extra benefit, honestly, I don't think it's worth it to go through all of that effort. Also, from 1st April, there is going to be tax collection at source that's going to be applicable on these investments as well at the rate of 20%. So and the fact still remains that, again, it's very difficult as individuals to really figure out what stock to buy, right? So I would just say that let's leave money management to the experts. As I said, you have domestic mutual funds that take international exposure. I would think that that's the easiest way to actually get international exposure.
Okay. The other thing, which is growing in terms of chatter is P2P products, right? Peer-to-peer products. So for the uninformed, for our viewers, peer-to-peer service actually connects lenders and borrowers. So enabling individuals to get loans directly from others like them. And there are, of course, investment products here as well. Now, this is regulated by the RBI, so that doesn't seem to be an issue. But do you think this is a bit of a complex product, and is it better to avoid for at least a young investor?
Yeah, I mean, honestly, I think it's quite risky because you're basically lending money to people, who may not be able to get money from other banking channels, for example, or maybe people with a lower credit score. And I always feel that, is this what you want to do with your money? Is this, you want to lend your money out? Is that what you want to do with it? So somehow I'm not in favor of these products because I feel, again, these are very nascent. We really don't know what are the default rates right now. And also, in case of a default, right, I don't know how much the platforms would really be able to help you. And I just feel that, right now we are just not aware of the sort of risks that are involved. And a lot of people are drawn into it because they're giving you this 12% and stuff like that. But Anybody who's giving you, 50-60% more than what a bank deposit can give you, it does mean that it comes with a very high amount of risk.
Absolutely,
So
absolutely. And it's
if
not
you're doing-
sustainable, right? I mean, money doesn't come easy. Got that. We have very little time. So there are two more quick questions I want to squeeze in. Debt funds, right? I'm sure you get a lot of queries on that. With debt funds being fully taxable now, the interest in direct investments into bonds is picking up. Many NCDs, covered bonds are giving 9 to 12% per annum. Fixed returns are available here. But how do you see these as an investment opportunity?
So again, concentrated risk, right? So if you're doing this, remember you're taking a concentrated risk, because tomorrow if the company defaults, your entire capital is gone, right? And again, I've had a lot of investors asking me about these bonds. Most of them, I don't think, understand the meaning of the ratings. As long as they see a A, they think it's a good rating, but a single A versus a triple A, there's a lot of difference, right? So I think you just need to be mindful of some of these risks that are there in these instruments, and not just go by the return. Also look at who is the manufacturer of the bond, which is something that a lot of people are not looking at as well.
Okay, and finally, you've told us what not to do, but just summarize it for us. What's a good way for a young earner to invest and create a rock-solid corpus?
We always try to complicate our investments when you have very simple investments available. So on the short term, which is up to 4 to 5 years, clearly up to, I would say, you have fixed deposits and you have short duration debt funds available. The debt funds, although they're fully taxable, I think they'll give you a slightly higher return probably than what an FD can give you. But, if you find it difficult again to figure out which debt fund and all of that, just stick with the fixed deposit, right? If you're looking at medium term, between 5 to 7 years, right, you have balance funds that are available. You have the dynamic asset allocation category that's available over here as well. And clearly, if you're looking at above 7 years, I would say look at equity funds. I think there's some really good equity funds today in India. And for the very long term, let's say for a retirement perspective, you have PPF and you have NPS. So all of these products are extremely low cost, and have a good history of performance, and have provided consistent returns. So I would say FD, balance funds, equity funds, NPS, and PPF.
And two quick equity funds top of mind that stand out for you?
On the Nifty 50 fund, I like ICICI Nifty 50 fund, Parag Parikh Flexi Cap fund, and DSP Mid Cap fund.
Okay, on that note, thanks a lot, Mrin. Very, very helpful for all the young investors, the young earners out there. This is a great way to build a rock-solid corpus. Thanks a lot for joining us on Smart Money.